Welcome back to Squawk Box. Goldman Sachs says that oil prices likely to fall through 2026 as rising production is creating a surplus. Joining us right now is Daan Struyven. I've always mispronounced his name. Every time you come on, I apologize. It kills me. Goldman Sachs is co-head of Global Commodities Research. Good morning to you. We're looking at WTI crude right now at $59.96. And you think this is coming down by a lot?
We have WTI declining to a 52 average for next year.
Okay.
Brent mid-50s, TI low 50s. We think 2026 will sort of be the last year of this big supply wave the oil market is going through. And then we think in 27 the market will rebalance.
And rebalance to what?
So we eventually think that after years of low investment, with demand growing through 2040,
right,
and with U.S. shale maturing, that eventually by late 28 or so, you should go back to Brent 80
right,
and TI 76. But right now, the focus is very much on the big increases in stocks, in oil inventories we're seeing at a pretty big pace, 2 million barrels per day over the last 90 days.
Right.
But we think this is sort of the last big supply wave the oil market has to work through.
So if you're right, nobody should be buying oil right now.
We think that there will be an attractive opportunity down the road.
Down the road, but not now.
Right now, we actually recommend to investors to express or view that prices will decline further,
right,
with short positions.
So the question, though, so you're suggesting people actually short oil. At what point? I mean, timing is a very tricky business, whether it's equities or, frankly, the oil business. So maybe it's different in your business. Is it much easier to time commodities, you think?
So I think that commodities are more spot assets.
Right.
We typically find that oil prices sort of run perhaps 2 quarters ahead of
right,
inventories data, but equities, especially for instance the tech stocks, can easily look decades right, ahead. So that's why we're laser focused on the inventories data, which support our view that the market is now in a large surplus that we estimate at 2 million barrels per day for next year on average.
And if you think, therefore, that WTI and Brent's going to drop precipitously, but basically $10 or $8,
yes,
that should have a real impact, a boost to the economy, the broader economy.
We think the net impact on U.S. growth would be modestly positive because the boost to consumer spending from higher real disposable incomes should outweigh the slowdown in U.S. shale capex and U.S. shale production, which eventually will help to rebalance the oil market.
Well, that's what I was going to say. So where is this supply going to come from long term?
In the long term, supply growth we think will mostly come in the long term from OPEC, which still has spare capacity and is investing in expanding its production potential, including natural gas liquids, and some modest growth from U.S. shale also in the early 2030s, but that would require Brent around 80 or so. And we think that's necessary if demand keeps growing through 2040, which is our base case. Okay,
we have MBS in town in Washington with the president. Where does what Saudis play in all of this? And I ask partially because, they went down the whole road a couple years ago of, they're going to build NEOM, they're trying to diversify their entire economy away from fossil fuels. How quickly is that ever really going to happen? And do you think that whole idea has shifted?
Yeah, so we think that Saudi Arabia has raised production this year for several strategic reasons to increase the cohesion within the group, to make sure everybody is contributing to stabilizing the markets. And we also think that Saudi Arabia, by bringing back to the barrels to the market, has reduced this perception in the oil market that there is plenty of spare capacity, which had been weighing on oil prices. And finally, if the market goes lower from a price perspective in 25 and 26, this should also slow down non-OPEC capex and support demand. More broadly, we think that core OPEC leaders like Saudi Arabia and the UAE can deal with a period of lower oil prices, high reserves, borrowing capacity, and to your point, they can reprioritize capex into the tech sector, for instance, with big AI ambitions there.
Dan, I want to thank you for coming in this morning. Appreciate it.
Thanks a lot.
Thank you.